Hey there, students. My name is Nathan, and I am a Chegg tutor. Today we're going to be talking about FIFO, which is a type of inventory system in accounting. It stands for first in, first out. So when they mean first in, first out, they mean that the oldest purchases, so the very first purchases that you made as a company, those go out first when you make a sale. Once again, the oldest purchases go out first when you make a sale. So those oldest purchases are charged to cost of goods sold. Now, with FIFO, it's going to have a few characteristics. So it will yield a lower cost of goods sold. Now, this is assuming that prices are rising. So as a company, you buy inventory over time, assuming that prices are going up to purchase that inventory, you will have a lower cost of goods sold. Now, the reason why is because you choose the oldest purchases, which have the lowest prices. So you have the oldest purchases, lowest prices. Those are charged to cost of goods sold first. Therefore, you'll have a lower cost of goods sold. Now, if your cost of goods sold is lower, that means also that your net income will be higher. Lower costs, higher income. Now, if you have higher net income, it's going to yield a higher tax liability. More income, the IRS taxes you more. And since you have the oldest purchases that go to cost of goods sold, that means that all your newest purchases, which again, if prices are rising, would be the most expensive, that's what's left over. So that goes to your ending inventory. And if the newest purchases go to your ending inventory, that means that your assets, your current assets, will be higher because the newest purchases are priced at the highest. Again, if prices are rising. Now with FIFO, to tackle a problem, here's a few key steps. Identify your sales first. Now locate your sales in a problem and then go from there. From that point of sale, locate your oldest purchases and charge to cost of goods sold. So from the point of sale, look back to your oldest purchases. That's what goes out first when you make a sale. And whatever's remaining at the very end, you're going to assign to ending inventory. So those are some of the key steps here to tackle a problem. Now on the right side, we're going to go ahead and practice. So in this example, Link Corp began 2015 with 100 units at $5 each. Throughout 2015, they made the following purchases. On February 2nd, 300 units at $7. Another purchase on June 5th, 140 units at $8. Then on November 15th, 120 units at $10. And then here are your sales. March 18th, 250 units, and that's their selling price, $18. April 5th, 50 units at $25. July 30th, 100 at $32, and December 14th, 320 units at $34. So here are the questions. What is Link's cost of goods sold? What is Link's ending inventory? And what is Link's profit? So let's do cost of goods sold first. Again, start with your sales. So March 18th is your first sale, and you had 250 units. So if you look at March 18th, go to your oldest purchases first. Well, the very first purchase of the year essentially is beginning inventory, which is at 100 units at $5. So we're going to go ahead and use that here, and that'll be a January 1st inventory, 100 units at $5 each. So that's going to equal $500. Then that's only 100 units that you charged already. So you still have 150 left from this sale that you need to go ahead and charge to cost of goods sold. So go to your that was your oldest purchase, now go to the next purchase in line. The next purchase was on February 2nd. That's your second oldest, essentially. So you have 300 units in that batch, but all you need is 150. So take 150 from that February 2nd there. And that was at $7 each. So that would be 1,050. Good. Okay, so let's go to your next sale. Now, before we do that, though, let's go ahead and calculate some ending inventory so we can keep track of everything. At this point, you used up all of January 1st, so let's go ahead and take what we have left February 2nd. So you have 150 units left February 2nd. You might use these in a second, but it's good to go ahead and track it as we go along and look at these sales. So the next sale was on April 5th, and you sold 50 units. Well, April 5th, look back to the oldest purchases first, and that's from the February 2nd batch. So we go ahead and take that here. So February 2nd, and take 50 units from that batch at $7. So that's going to be $350 there. So now you only have 100 units left. All right, go to the next sale, July 30th. And that's going to be 100 units that you sold. So you actually have 100 left in that February batch. So let's just go ahead and use it. That's your oldest there from that point. And that's at $7. So $700 there total. So now you don't have anything left in February 2nd. From there, we're going to go to the last sale, which is December 14th. And you sold 320 units. So take it from the oldest batch. Well, you used up all of February 2nd. That's gone. I'll put a little X next to it. So the next oldest batch is June 5th. So take 140 units from there. And that was at $8. So 140 times 8, 1120. Okay, and then you sold 320, so that means you still have 180 units left to use. So let's take a look at the next batch here. November 15th, 120 units. And that was at $10. So that's going to be 1,200. And looks like you still have, let's see, about 60 units remaining we need. So I'll just go ahead and add another purchase here. Let's say you purchased another one on December 1st, and it was for, we'll just make it big. We'll say 400 units you purchased at $12. But you only need 60 from that batch there to finish out this sale. So on December 1st, just take 60 units from that batch. And it was at $12. $720 there. Okay, and so remaining, all you have left is just from this December 1st batch. That's it. You took 60 from it, so there's 340 left. Pretty simple there. December 1st, you took 60, so there's 340 units remaining at $12. So total ending inventory is equal to that. 340 times 12. 4,080. And then for cost of goods sold, we got to add up some stuff here. Just add each line up. So 500 plus 1,050 plus 350 plus 700 plus 120 plus 1,200 plus 720. So total cost of goods sold, 5,640. All right, from there, we need to figure out the profit. And all that is your sales minus cost of goods sold. So your gross profit. Well, sales, we know we made all of them here, every single unit. And we're going to go ahead and add these up here. So let's just go ahead and calculate them. So 250 times 18, 4,500. And 50 times 25, 1250. 100 times 32, 3,200. And then 320 times 34. That's going to be 10,880. So total sales $19,830. Total cost of goods sold 5,640. So we just go ahead and put that down here. So for your sales, it was 19,830. Cost of goods sold was 4,080. Oh, sorry, no, that's ending inventory. Cost of goods sold was 5,640. So your total profit is equal to 14,190. Again, that's your gross profit. So you still have to deduct your operating expenses and other losses, other expenses, other revenues and gains, and so on to get to net income. But this is just your gross profit here. Okay, well, hopefully that was helpful for y'all today. Again, with FIFO, it's your oldest purchases are charged to cost of goods sold first. Whatever's remaining, if prices are rising, are usually your newest purchases that are worth more. And those newest purchases will go to your ending inventory on the balance sheet under current assets. I know it's a lot of stuff, so feel free to go and rewind, fast forward to make sure you understand everything. Once again, thank you for listening. My name is Nathan. I go by Nathan G on Chegg.com for tutoring. So feel free to go to this link here and message me if you want some one-on-one help, homework help, exam prep. I'll be there for you. So just send a message and I'd be happy to help you out. Thanks for listening today, and I'll see you in the next video.